Hello everybody, Dwayne here from DRFX for swing trade. Taking a look once again at the Canadian Swiss franc daily chart. As you can see here, a major downtrend has been in place for this currency pair since 2010, and right now we're seeing that the market has basically, this downtrend has taken a bit of a pause as the market moves sideways to form this large consolidation setup. So I'm going to be examining the trading opportunities that are going to be arising as we continue to move inside of this consolidation setup. Now zooming in, we can see once again, as we were discussing in the last video, that this had the potential of providing us with a trading opportunity following the breakout from this range consolidation here. The market broke out of the consolidation with what we call a weak candle, and generally we avoid breakouts that take place with these weak candles. However, if it is followed by a type of signal that that meets our requirement according to our trading strategy, then we can trade it. Not only does that signal have to be in place, but the overall context of the trade has to meet our requirement as well. Now, one of the main reasons why we didn't trade it was because of the proximity to the resistance boundary of this large consolidation. Another reason had to do with the fact that the breakout equivalent of this range setup, as you can see here, would also have been a major impediment to actually trading this pair. Because of what? Because of what we know normally takes place at these areas. Whenever the market hits the breakout equivalent of the range setup, or any consolidation for that matter, it generally has a tendency to pull back. So if we had entered, say, at this point here, at this candle at 74.35, we really would not have had much in terms of a trading target. 60 pips, which is definitely below our minimum target of 100 pips from swing trading opportunities. So that would have been the main reason, another reason why I would not have taken the trade. The first one was the fact that it is generally too close to this area here, and we know that generally when we approach this area, the market tends to show, or opposing trading positions tend to be at these areas. So we'll be trading against the headwinds of the opposing positions that are going to be opened up once we get close to this area. So that would have been the main reason. And the second reason is that this breakout equivalent of this consolidation would have been very close as well. And as you can see here, the market pulled back following after hitting the breakout equivalent of this range. So this would have been the main reason why we would not have. These two would have been the main reasons: the proximity to the resistance boundary and the breakout equivalent. Now you recall that the way that we measure the breakout equivalent is different from how varies depending on the type of consolidation that we're trading. For normal consolidations, we have a particular way of measuring that, and here is an example of how we do that for this range consolidation. And once these targets are hit, the market generally has a tendency to pull back. Sometimes it will move sideways, sometimes it will pull back, or on rare occasions you will actually see the market exceed that breakout equivalent and move higher or go beyond it. But in most cases, once this target is hit, once you have properly identified it, the market will normally respond to this area here by either moving sideways or pulling back. So a very similar setup, smaller than the one that we just took a look at, but nevertheless, every consolidation, no matter how large or how small, always has their breakout equivalent target, and that's the area to which all breakouts head towards before the market pulls back. So the market did pull back right here, but as you can see here, a strong bullish candle has now taken over, and we could actually see the market go past this breakout equivalent and head to the resistance boundary. So overall, this would not have been a trade that we would have taken based on our rules, but based on this bullish candle signal that we're now seeing, this could be one of the exceptions that actually work out, that lead to the market actually going to where we thought it would not have been able to. But nevertheless, in most cases, 9 out of 10 times, the market will pull back significantly from this target once this target is hit. So if this moves towards the resistance boundary, it's going to be the it's going to be the exception to our trading rules. Now, in terms of what could take place from here on in terms of a trading opportunity, there are a couple of possibilities. The first, obviously, is that the market, if it reaches this area here, could then provide a setup in the form of a small consolidation, perhaps similar to this one, to then start a breakout bullish. So if that takes place, we could see the market break out towards this trend line here. In doing so, it could actually be the setup that leads to the start of a major trend change in favor of the Canadian dollar. Given the fact that we have been in this downtrend for a very long time, and generally after such an extended trend, and whenever we see the market pause and provide these large setups, large consolidations, or even head and shoulders bull count formations, it's generally an indication that the market is about to start a trend change. So this trend change is possible if we see a breakout above the resistance, that then leads to a breakout above this downtrend line. So that is the first possibility. The next possibility, of course, is that if we do get a rally, it could be short-lived, and we could see the market head towards the support boundary once again, providing us with a trading opportunity to go short. So just to summarize this pair, the bullish scenario is possible because we have been in an extended trend for this pair over 6 years, and after such a long time, the market generally has a tendency to change direction with these types of large setups. And of course, the fact that we're currently bullish gives the market a bullish bias right now. However, on the other hand, we're near the resistance boundary, and the breakout equivalent of this consolidation has been hit. So these two reasons could provide sufficient momentum in favor of the bears to change direction and give us a U-turn and a trend to head back towards the support boundary.